Welcome back, investors, to Ticker Time News. I'm Adam, and for the second straight day, the stock market had a broad rally. The major averages shot higher at the open, and they never really lost their footing, closing with sizable gains and near their best levels of the day. The SPX, or S&P 500, was up 3%, the SPY 3.1%, the Qs 3.1%, and the IWM nearly 4%. Small caps are really kicking it off. And last week, we talked about what do we need to see for this bounce, this rally, this relief rally, whatever it is that we're having right now. Well, we need to see something hold its footing. And small caps at the end of last week, they were the ones that lost the least, and they would be the ones that would lead this rally. And boy, did they today. Nearly 4% for the IWM, which is your Russell 2000. Now, in the last two sessions, the S&P 500 and Nasdaq Composite, they both have gained 5.7%. With new money flowing back into equities to start Q4, there is some hope that the beginnings of a relief rally is underway. Unfortunately, 2 days of strength does not constitute a valid trend change, so traders and investors must remain cautious at best with any longs that they want to play. I mean, look at today's candle, a giant gap up from yesterday's close. And then on top of that, it is way outside of its weekly expected move. Now, I know the options market, it has not been very efficient of late. And this could just be another sign of that inefficiency with the candle being so far outside of the weekly expected move. I mean, the weekly expected move is that the two purple lines. The options market, 68% of the time is correct that by the end of Friday, we will close within these two purple lines. But look at this candle. It's way up here. So does that mean that this relief rally is almost over? Is this it? Could we maybe get one more day up to that 20-day moving average and then call it quits for the week, and then by Friday it's back into its channel? That is a possibility, and one that we should consider. However, this thing is going pretty strong from severely, not severely, extremely oversold conditions. So this thing is moving pretty fast. We need Kramer to say the coast is clear. The inverted Kramer index, right? That's what we need. Okay. With this big jump today, it's still under its 200-day, its 50-day, and 20-day moving averages. We were in a deep hole last week. So climbing out of that hole, yeah, we're going to get some momentum on our side. I mean, look at the RSI down here. It is still at a 38. Yeah, a 38. That's only 8 points above being oversold. So we still have some time on our side for this rally to continue. One thing that I do want to point out, especially on the SPX and the SPY, is we ran into traffic the last time we were in this range here. And I'm going to highlight this area right here where we were up and down. Volatility was crazy. The chop was real. And we moved sideways in a very choppy environment. I mean, we had 3% days, a 2% day. What else do we have in here? A few 1% days in here, a 1.5%. So there were some big moves, and there's another 3% move right there. So we had big moves during this time, and we were bouncing out of an oversold area. I mean, it got extremely oversold here. Not quite as oversold as we got here when we hit our new lows for the year. But let's see, a 22 on the RSI versus a 27 on the RSI. So not quite as oversold back here on the left side of the chart, but there is some similarities here with us coming into extreme oversoldness over here. And now we're rising back up. We could very easily get into this channel The 50-day is up here. The 20-day is right there. It could very easily be that we rise all the way up to the 50-day. Maybe this rally has it in it that we can get that high before the middle of October. Because remember, we are up against a time crunch right now, and that time crunch is the middle of October. That's when things switch over and we lose momentum and we undercut the lows made in September. Okay? So again, a crunch time frame. Back here on the left-hand side of the chart, from the time we really bounced, let's see, June 17 to the time we broke out of that was July 20th. So again, the time frame kind of matches up. We could see severe chop from now until the middle of October, maybe slowly cranking our way higher as we go. However, with that time crunch, it's going to be limited. And once we reach that middle of October time frame, and again, it's not a exact science. It's not like on the 15th of October. That's when things are going to change. But it'll be within that time frame. And it's going to catch a lot of investors off guard who are not prepared for that end of October meltdown. So be cautious, be careful, still use small position sizes with whatever trade you take, because this volatility is just going to be incredible. Now, in bear markets, rallies that stall happen, okay? So also be on the outlook for that. At some point, this rally, it's going to hit a wall, whether that's the 20-day moving average or maybe all the way up to the 50-day moving average. Something will be there to stall this out. But we have a little bit of time before something like that happens, I think. If it is 2 weeks that we have, we do have to consider where the weekly expected move is. I know the options market has not been that efficient of late, and that can carry over week after week after week, as we have seen. But at least have that written on your notepad. Okay, where are the weekly expected moves? Okay, I'm watching that. Where is momentum in the market? Remember, yesterday I mentioned financials. If we're going to see a sustained rally, financials have got to gain their footing. They have got to, at the bare minimum, consolidate. They report first when the earnings season starts upon us, which is Q3 earnings season. It's coming up in just a couple weeks. So we have that also to watch out for. But if banks can consolidate, if banks can start to creep higher, which they did today, although I will say, with the inverted yield, the financial sector could potentially be a really good sector to short in this upcoming earnings season. So I've got my eye out for shorting financials when we get to mid-October. I think there could be some opportunities there. So maybe put that on your notes and keep that on your radar as well. Now, with this bounce that we have, don't want to miss your questions. Do you think the market will stop pricing a good CPI print and Fed pivot again? That's a great question. Let's throw that up on the screen here, and let's think about this through for a moment. Let's try to be a little bit logical here. With the market's mentality on a potential Fed pivot and a good CPI print, meaning inflation going down, the market was taught a lesson. And let's just do this here on the chart real quick. The summer rally, okay? The summer rally, the market was taught a lesson. Let's get this summer rally pulled up. So the summer rally, that was front running, which we could say it was from the level we're at right now all the way up to we reached that peak in mid-August. The market was front running a Fed pivot. Now, will the market do that again? I think yes, because I think a lot of today's momentum was driven on the idea of a potential Fed pivot, or at the very least, the Fed slowing down. Because today's driving forces in the market, it continued to be the offside positioning and I believe the hope that the Fed will take a soften its rate hike approach. Maybe instead of going 50 basis points or 75 basis points, maybe they dial it back to 25 basis points. I mean, the Reserve Bank of Australia today, that really gave this market its launch this morning. And if you didn't hear, the Reserve Bank of Australia made a decision to raise its cash rate by only 25 basis points instead of the expected 50 basis points to 2.6%. Because officials recognize that the cash rate over there in Australia has been increased substantially. And that's exactly how it's been here in America. The Fed has raised rates substantially. Now, the Reserve Bank of Australia, in seeing that rates have gone up really fast in a short period of time, they wanted to take some time and wait and see. They wanted to wait and see what the impact of the prior rate hikes would do for inflation and economic growth. So the big jump today is the Fed, the market participants thinking that, okay, could the Fed take a page out of the Reserve Bank of Australia's playbook and say, hold up, we've been raising rates super fast in a very short period of time. Maybe we should dial it back a little bit and see what our rate hikes will do that we have already done. Unfortunately, I do not think the Fed will do that. Why? Because the Fed's mandate is to bring inflation down to 2%. And they are going to over-tighten and raise rates so fast all the way through 2022. They've already said that they're going to do that. And I do not think that Fed Chair Powell, who's on his very last assignment, right? Fed Chair Powell, after this is over with, he's done. He's out. He won't be Fed Chair any longer. So, like Paul Volcker back in the 70s and 80s, he went out with great big rate hikes. Although Fed Chair Powell, his rate hikes have gone even further than Volcker's. Now, Volcker, he went from 10% at a Fed funds rate all the way up to 20%. Can you imagine what 20% would look like today? That's just crazy. But that's only a 2x move. We have already gone, 3-4x from where we started, because we basically started at 0 to 0.25%. And we're headed to above 4% by December 31st. That's a big, big move. So yes, I think the market can have blinders on. They'll see what other federal central banks will be doing, and they could very well think, well, you know what? That seems logical to me. I think our Fed's going to do that too. And then front run this thing again until either the November meeting, because remember, there is no October FOMC meeting, so there will be no rate hikes in October. But we do get a CPI read, right? And we do get information on the employment front. We get data for that all month long. So, yes, I do think the markets can have blinders on and front run again like they did during the summer rally. Now, I do not believe this rally is going anywhere near where the summer rally went at about 4,300 on the S&P 500 and about 340 on the SPY. I'm sorry, not 340, 440. Or is that right? 430, excuse me. Get my numbers mixed up there. 4,300, that's about 430 on the SPY. So yes, I can see the market front run here, especially looking at what Australia did today. That really led the way for the markets to rise like they did today. However, I want to see how markets fight the Fed. Yeah, man, oh man. You know, with that there, I want to see how the markets fight the Fed. It has been doctrine for nearly 14 years. Don't fight the Fed. The Fed is your friend. Quantitative easing has been the market's bread and butter for the last 14 years. That's not going to continue. QE, it may be gone for good. The next time we get into an economic crisis, we may not be at 0%. Because once there, I mean, what tools do the Fed have to fix an economy that's breaking, that's slowing down? You usually take rates down to help a slowing economy. Right now, Powell's taking the rates up in a slowing economy. So, yeah, it will be interesting to see that. I do think we've got a 2-week time window here for the markets to really abandon any type of reasoning and go to wishful thinking and speculation. So keep an eye out for that. Now, another thing that we had today was the US dollar. The US dollar index, it fell sharply today. Let's pull up DXY. That's the ticker for the dollar. And look at this pullback. This dollar has been hot all of 2022. And the US dollar and the S&P 500, the SPY, have had an inverse correlation relationship all year long. The dollar is cooling off fast. It had a big down day today. As a matter of fact, it fell sharply today on growing speculation that the Fed will take cues from the Reserve Bank of Australia and soften its approach going forward. So the US dollar index being down 1.4% today, all the way down to 110.17. It's at 110.20 right now. Not much of a move since the market closed. Now, this pullback, I think we can come a little further. I think we can come to 109 and still we would be making higher lows, okay? Just think, the low right here on September 13th was a closing low of 110.0. Before that, the closing low was 108.3. So somewhere between these two lines, I think the dollar could pull back even further. And again, we would still, as long as we held above that closing low of 108.3, we would be making a higher low. We already put in our higher high for this run right here. You can see it's higher high after higher high all year long, just all the way up. We're also making those lower lows. I mean, higher lows, excuse me. So as long as we don't undercut 108.3 and bounce off of that somewhere in between these two areas, 108.3 and where it is now, then we're not going to be undercutting and making a lower low. It would still be a higher low, and this dollar could still run. Now, at some point, this dollar will have to cool off. One of the big reasons why the dollar cooled off today was weak U.S. manufacturing data that we got. Also helped to drive down not just the U.S. dollar, but also the Treasury yields. They came down today. This is, in turn, it actually caused gold to move back above 1,700. Gold's something we hardly ever talk about. GOLD on TradingView, and there is a link in the description to TradingView. It's free, doesn't cost a penny to use. Look at gold. The complete opposite here of the dollar, right? This rally that the gold has been in. Let me do this. I'm going to overlay the Dixie, DXY, which is the US dollar. And you can see. Here we go. Inverse correlation. I know there's a lot of lines on here and it's tough to see, but the orange line up here, which has been, hot and heavy, running a rally as as gold has been cooling off and continuing to fall, but now the reverse has happened. The dollar has been weak. You can see that there in orange, and as the dollar has cooled down, gold has been rising, and it's back above $1,700 an ounce. It's at $1,725 an ounce right now. So this is good, not just for equities, but for gold, right? And with the dollar cooling off like this, something else that popped today is silver prices popped with gold. Silver actually popped to its highest level in more than 3 months. So gold and silver both. When the dollar's cooling off like this, they're both rising. So if you ever wanted to do a gold trade, watch for weakness in the dollar. That is going to help offset gold. Something else that helps to offset gold is copper prices. When copper prices are coming down, and we've looked at this a couple of times on the channel here, but Dr. Copper, the copper to gold ratio, that is something to keep an eye on, because copper is seen as the metal of the economy, because it's used in nearly everything our economy produces. So when copper prices are going up, usually the economy is going up right along with it. But when copper is coming down in price, that usually means so is the economy. And that's what's happening. But when copper goes down, gold goes up. So also keep that on your radar too. A gold trade is definitely likely. But one thing to point out here, gold ran up to its 50-day moving average. That'll be a key little test there of confidence, because if we go back here, not too far, let me make sure my highlighter is out. The 50-day moving average, gold undercut it back here, okay? This was back in April of this year. And since April, gold has come up. It's tested that 50-day at one point right here during the summer rally. Gold broke above that 50-day, its 50-day moving average, but that was it. It held it for a couple of days and then down it went. So the summer rally helped gold, not too much, but a little bit. Right now, we are up against that 50-day moving average again. Can gold get above it? Can gold stay above it? If the dollar stays weak, then yes, gold can. If copper prices stay weak, yes, gold can. So that's two things to watch to help you if you want to get into a gold trade. Now, right now, watch that 50-day, because that'll be a big one. Now, there was the sense of maybe a short squeeze taking place in the market from extremely oversold conditions from last week, the stock market. And, maybe even I'm going to call it a sideline squeeze, as sidelined investors, maybe they're feeling the urge to put sidelined cash back to work after an ugly month of September. And did you know that the S&P 500 at the close of September was down 24.8% on the year? That's just incredible. over 20% in bear market territory. And you didn't really hear a whole bunch about bear market territory since the last time the S&P got to bear market territory in June. And of course, that's from last Friday's close. Now, let's dive into the sectors here, and then I'll come back to the SPY and the Q for tomorrow. All 11 S&P 500 sectors, they were in the green today with, let's look at this. Look at a right-hand side of your screen here. Look at this column of percentage points over here. It was an amazing day. It looks like consumer staples, XLP, the ticker. It was up 1.5%, and that seems to be the slimmest winner today. 1.5% was the was considered the loser today in this list. Now, XLE, that's your energy. It was the biggest winner today, up 4.3%. Let's pull that up. 4.3% gain, and it was the biggest winner of today. Now, the energy sector was boosted by rising oil prices. And let me tell you, from yesterday to today, there was a big change in oil for one reason. So, again, these are not the updated weekly expected moves. I do not update them on the live stream until Wednesday because I send them out Sunday evening to our private investor community. So I let them have it until Wednesday before I do update them. But look at these gaps up yesterday, huge gap up, and the gap up today. Yesterday's gap up over the 200-day moving average. Today's gap up over the 20 and 50-day moving averages. So energy has been on fire. Now, let's look at oil and why oil was up. U.S. oil is the ticker to remember. Oh, and real quick, if you want to get the weekly expected moves Sunday evening, just click the first link in the description. Okay, why did oil catch a pretty big bid today? Well, remember yesterday when we were talking about reasons why oil shot up? Well, one of the big reasons oil shot up yesterday is because there were reports that OPEC Plus was considering putting the squeeze on oil production by 1 million barrels a day. That's right. Today's report says that OPEC Plus is considering a 1.5 million barrels per day cut to production at tomorrow's meeting. Another 500,000 barrels being cut per day in just 1 day change. So the reporting on this, is it clean? Is it accurate? I don't know, but I will say that between 1 million and 1.5 million barrels being cut out of the supply per day is going to have a big impact on the price of oil. Now, the update today came from the Wall Street Journal, so take that if you will. Oil rose 3.4% today and closed at 86.31 a barrel. It's at 86.63 now in after hours, up 0.4%. Oil, this blue trend line that I drew yesterday, it could continue on that trend line, but I think tomorrow at the OPEC Plus meeting, whatever decision they make, that decision will affect oil prices and whether it can continue along this trend line or not. Now, I will say, oil right now is disconnected from that 5-day EMA. And remember, I like to think of that 5-day EMA as a circuit board. If the candles are not connected to the 5-day EMA, they will within the next day or two, that quick. It's disconnected right now to the upside. it usually doesn't stay disconnected for more than a day or two. So I'm expecting a cool off in oil within a day or two. So don't go long on oil right now and try to do that. Plus, the 50-day moving average is catching up. That's at 87.97. So we've got about what, $1.50, 250 before oil is at that 50-day moving average, and it's going to act like a very stiff resistance also. So that's also coming up. The last time oil got to that 50-day was right here, and it hit it and fell the very next day, and that was at the end of August. All right, something else that we need to talk about. It was in the news a lot today. It caused shares to be halted. You couldn't trade them, and that's Twitter. TWTR. Twitter shares surged today. There's no other word that I can use. Up over 22% on the day. And like I said, trading was even halted on Twitter today. Why? Because Elon Musk filed an amended 13D notifying Twitter that he intends to proceed with closing the buyout transaction, I should say. It will be a transition period for sure. Now, press reports circulated that the company intends to close the deal with Elon Musk at $54.20 a share. That's why shares took off. Closed today at $52, $54.20. So there's another $2.40 or $2.20 that can be milked out of this potentially, if the deal does go through and happen. Now, it seems likely. You don't update those forms with the SEC for no good reason, and you certainly don't lie on the forms. So it does seem likely. Now, whether or not $54.20 will be the final price, who knows? I sure don't. But it does seem in the realm of possibilities. And market sentiment today also believed that $54.20 could very well be in the cards for what Elon's going to pay for Twitter. Elon's biggest mistake, it is interesting for sure. It's almost like overnight when Elon made the announcement about putting a bid in for Twitter. It seemed like overnight, half the country enjoyed it, half the country did not. Whatever the politics of it right now, I don't care. This isn't a very political channel, to say the least. But whatever the case, I believe in the First Amendment, free speech. It should be protected. Twitter surely does seem to become the digital courtyard for today's society. So whatever Elon does with it, it's up to him, I guess. If it's his company, I guess he can do with it what he wants. But I'd be more focused on what Elon's doing with AI, I think, than what Elon would do with Twitter. I think that has got a real potential to upset the apple cart, if it were, for our economy. I mean, if Elon's robots can really join the workforce, I mean, wow. Our economy, we haven't seen how high it can go. I mean, the productivity, there's some things politically that would need to be worked out, but as far as productivity, gosh, it would skyrocket. Okay, enough thinking about that. That's Twitter. Went up today. Had to bring it up. It looks like the deal is going through. Okay, let's talk about Treasury yields. They were lower in the morning trade. Let's start with the 2-year US 0. Oh, get the cursor back over here. All right. US 0 to Y for the 2-year. Yeah, I think it was just a joke that went too far in his end. Yeah, it did. My goodness. All right. 2-year is cooling off. It's got a little hammer candle right there, which could signal that, hey, maybe this 2 years cooled off enough for right now. So that's something to keep an eye on. But with the Treasury market, the yields were lower this morning, offering support to the stock market, as it were, before settling well off session lows. And that's where that hammer candle comes into play. The 2-year, which was at 4% earlier, settled down 3 basis points to 4.08, and it's at 4.09. You could call it 4.1 right now in the after hours. But that handle candle right there signaled that there was enough support down here for it to shoot back up and then basically hold where it opened. And those hammer candles, they can represent reversals. And it almost came down and touched its 20-day moving average. I figured that it would come down at least to that because it had gotten so overextended to the upside. Another reason why a bounce was inevitable here. But this hammer candle does look like maybe it could be slowing down. Maybe it just starts to move sideways, but big moves lower, not according to this candle. Now, of course, things can change. The Treasury market does have a big driver that is due to the headlines, right? And then the 10-year, US 10Y for the 10-year, it hit 3.56%, settled down 3 basis points. That percentage point was this morning, and then in the afternoon, 3.62%, sitting there right now. Today, like yesterday, the wick did come down, touch the 20-day, and then pull back up. But today, we've got that hammer candle over here as well. Now, I believe it was last week, I posted on our Patreon and our private channels on Discord that a hammer candle is something I love to trade. It's super simple. You can use FinViz and you can search for that specific strategy for the hammer candles, and you can look for stocks that have formed one, because it typically does mean that a reversal is coming. So it looks like with the 10-year dropping below that trend line that it has held since the middle or beginning of August, that maybe it has fallen far enough and it has gotten disconnected from that 5-day moving average on the underside of it, that maybe tomorrow we could be seeing it pop back up above that trend line or right there at it and reconnect with that 5-day EMA. The 5-day EMA is at 3.68%. So it's not a big move, but it is a move to the upside on it. All right. Let's talk about some of the economic data that we got today, because that did affect the market this morning. Factory orders for manufactured goods were unchanged month over month. The expectation, though, was a positive 0.4%. Shipments of manufactured goods jumped 0.5% after decreasing 0.9% in July. So, market participants saw that as a good thing. But the key takeaway here is that it marked the second straight decline in new order activity. However, the 1.4% increase in non-defense capital goods, which excludes aircraft, suggests business spending is still on the rise, even if it's just a tiny little bit. Then The August JOLTS job openings came in at 10.053 million, following the prior reading of 11.239 million. Either two things are happening. Either jobs are being filled, and that's why that number has come down, less job openings because they're being filled, or, and this is what I think, companies are pulling the job openings without those job openings being filled. The reason I think that, well, one thing to note, this number has now dropped for 2 months in a row. With the number of companies that have publicly placed a freeze on hiring, or have laid off employees, or have said that they are not going to take any more employees on, or have rescinded job acceptance offers, has me believing that this number is coming down because companies are taking jobs off the market without those jobs being filled. So, what do you think? Do you think that number is coming down because jobs are being filled? Or is that number coming down because companies are taking those jobs out of the marketplace before they get filled? I think it's the latter. Now, looking ahead to tomorrow, market participants will receive the following economic data. 7 a.m., we get our weekly MBA mortgage applications index. Last week, it was down 3.7%. At 8:15 a.m. Eastern, we get the September ADP employment change. The expectation is 198,000. The prior reading was 132,000. That means unemployment is rising. Then at 8:30 a.m. Eastern, we get the August trade balance. The expectation is a loss of 67.9 billion. The prior reading was a loss of 70.6 billion, and that came down from the prior month. So that means we are selling less, our exports, but we're also buying less with imports. That goes for a slowing global economy. Then at 9:45 a.m. Eastern, we get the September final IHS Market Services PMI. The prior reading was 49.2, which is a contracting number. Will it still be a contracting number? Most likely, yes. Then at 10 a.m., I know there's a bunch coming out tomorrow. At 10 a.m. Eastern, we get the September ISM non-manufacturing index. Expectation is 56%. The prior reading was 56.9%. So even though that is still in the growth percentile, it is slowing a little bit. Okay. That's all. That's everything I had to talk about. I'm going to go to the SPY and the Qs to talk about tomorrow. While I pull that up, if you could do me a huge favor, if you have questions, plug them in now. Now is a great time to do it. And then click that like button, share this video with a friend. Those two things help out this channel greatly. And if you like the perspective, you want more, click the first link in the description. And I'd love to see you there. Okay, for the SPY, with this big jump today, this morning, this big gap up, this pull away from the weekly expected move, I think the options market might have had it a bit on the underside this week, not moving so much, being scared to go too much. With that said, I think the 20-day moving average, which for the SPY is at 381.7 right now, I think that could be a bit of a stumbling. a little bit of a slowdown, a little bit of a wall right there. I also think that we did jump pretty big today. It wouldn't surprise me to see a pullback tomorrow, or at the very least, not such a giant move. I mean, yesterday was 2.6%. Today was 3.1%. So I don't see another big day. Not at all. 20-day moving average, again, 381. We're at 378 right now, we'll call it. I think that will be resistance. So we could hit that, we could pull back, we could move sideways, but I don't think we're going to get another monster run like we've seen over the past 2 days. The market, I think, will catch its breath tomorrow. Now, headlines, they're going to play a role, just like they did today, just like they did yesterday. Although yesterday was more so an extremely oversold market. Now, on the Qs, let's pull them up. The Qs look nearly identical. One thing different between the SPY and the Qs, the SPY moved up a little bit faster yesterday, leaving it with less of a gap today. The Qs had this nice gap up right over that weekly expected move. The 20-day moving average is at 286, and we're at 282 right now, so not far off. I think that'll slow us down, because that right now, that would put us with the 20-day right in the middle of this mess right here. So we had a ton of reactions around that price point. That could definitely see some resistance. Plus, on the volume shelf profile, the biggest volume point was right here, okay, which is right about the 290 area on the Qs. So I think that's going to be a bit of a resistance area. So anywhere between the 290 and the 286, I think that's going to be resistance for the Qs. Okay, let's go check out the IWM right quick, and then we'll wrap this up. Let that load. I mean, small caps have just been on fire. But here's what I think. The small caps did it today, and this is what I think could play out for the SPY and the Qs. It ran up to its 20-day moving average. That's where it stopped today. So we got that. It's over its weekly expected move. You can see that gap up right above it, just like the SPYs and Qs did today. And you can see here last week, small caps, they held their own and didn't fall as far, which gave them a nice launching pad. But again, that 20-day moving average is at 175. It closed at 176. I could see a pullback in small caps tomorrow, with this being a bit of resistance. And if we go back just above that, right here, right here, right here, right around that 177 area, that was resistance for the IWM. It was also support right here before falling through here. So I think we're in an area of resistance. 177, 178, I think could be tops for tomorrow. So not a big move whatsoever. All right, that is everything I had on my mind. If you guys are good, I'm good, and we can wrap this up for tonight. So I thank you very much for joining me. I greatly appreciate each and every one of you for hanging out with me every evening. I'll be back tomorrow after the market closes to go over what happened, why it happened, and what to expect. All right, ladies and gentlemen, have a... Oh, did you check out Lance Roberts? I did. I did not watch a video. But I'll watch a video this evening. I admit I did forget about it right after the live stream, but it's written here in my notes, and I did look it up earlier today. So I'll watch a couple videos, and I'll see what that's all about for sure. I promise I will. And then I'll talk about it tomorrow. How about that? Make sure to put that in here. Talk about tomorrow. All right. Cool. Well, I greatly appreciate each and every one of you. And again, thank you so much for joining me. I'll be back tomorrow. You guys have a wonderful evening. And you are welcome. Let's see what happens tomorrow. Absolutely. Oh, there was one thing. No, I had forgotten about it. Oh, those in the investor community, I did put out our top 10 momentum stocks for this week. They went up right before the live stream started. So check your email or notifications for Discord. They're on both. An interesting move there. And then I put a little note with it to talk about why that move took place and what to watch for that move to continue. Okay, so make sure to check that out. All right. Have a good evening, and I'll see you tomorrow.